This is Dan Sullivan. I'm the president of the Council of Georgist Organizations, and this is our virtual interview series in lieu of our annual conference. I'd like to thank the Robert Schalkenbach Foundation, which has traditionally given us a fairly substantial grant to help with the conference, and has given us a smaller but still substantial grant to do these interviews. I have with me today Walt McRee. Walt is the, you're like a senior advisor to public banking. I'll let you do the exact title. And Walt is, Ellen Brown is the person most associated with the public banking movement. And Walt is one of the people that's been pushing this, particularly in Pennsylvania, and also has spoken on it. If you want to hear Walt McRee's if you just search on Walt McRee Banking on YouTube, you will get several videos of his speaking. There was one was called The Urgency of Public Banking. That was when he was preaching to the choir, so it was kind of a hard sell. We got to get out there because this is the greatest thing to happen to the world. But there were also two interviews. One of them was with Ralph Nader, which was an excellent interview, although the audio wasn't quite up to snuff. And the other one was a guy named Kolb, or I'm trying to remember his name, but that was also a good interview. He seemed to be coming at it from more or less the left, not hard left, but those were also good interviews. And I wanted to first talk a little bit about Henry George and money, because there are three major competing monetary reform movements right now, and public banking is one of them. I think it is closest to the Overton window. In other words, I think it is the most immediately feasible of the three. One is MMT, which is modern monetary theory, which basically advocates that government do more deficit spending in order to generate the revenue it needs for things. And the third is it's most famously positive money in the United Kingdom, and it is the Alliance for Just Money, I think, in the United States. It was originally the American Monetary Institute, which was a strictly educational thing, and the Alliance for Just Money is more of an advocacy group. But Henry George was closest to the Alliance for Just Money, in that he believed that government should create all the money, that banks should lend only from term deposits, and that, and I think that is, putting my own bias out there, I think that is the ideal way to do it. That we had Richard Vague on 2 days ago and talked about how banks create too much money during booms and then create not enough money when the market peaks, and that causes the recession. So he traced 43 recessions and depressions of the past 200 years to commercial expansion and contraction of credit. And so that's basically Henry George's view on money, was that government should create the money. And the two big movements of the 1880s were the land value tax movement, which was Henry George's primary effort, and the greenback movement, which grew out of Lincoln issuing greenbacks in the Civil War, but it really caught on with a lot of progressives at the time. And I also mentioned, whenever I use the word progressive today means socialist, but the progressives of the 1880s were more or less libertarian, not in the sense of the libertarians today are far more right-wing than the libertarians were before there was a reaction to FDR and his big government programs, and that reaction attracted very anti-government people to libertarian movement. Before that, libertarians were mostly anti-privilege, and the progressive movement until 1913 was anti-privilege. Now, Woodrow Wilson put a lot of Henry George's people and a lot of Greenbacker people into his cabinet, but he was a professor. He wasn't really an experienced politician, and he got conned, is the nicest way to say it. He got conned into believing that the income tax would be a viable substitute for land value tax, which is what the progressives actually wanted, and that the Federal Reserve would be a viable substitute for the greenback dollar, because the Federal Reserve could issue money just like the way greenbacks are issued. And even though they could, they don't, because the large national banks essentially captured the Federal Reserve. Whether the Federal Reserve, there's this big argument about what is the Federal Reserve really public or privately owned, and my answer is there are public controls and private controls, and it doesn't matter, because the Bank of England is totally nationalized, has been totally nationalized since 1948, and it behaves almost exactly the same way that the Federal Reserve behaves. So I don't have don't put much stock in the importance of the question of whether the Federal Reserve is public or private. I think the greater question is the behavior of the commercial banks and the massive fluctuations in private debt. And so with that, I'd like to turn it over to Walt and ask first to start with just a real simple, dry, this is what a public bank is. Because all I know is it's a commercial bank owned by the public. And I don't know if there's any real structural differences between it and a commercial bank operated for private profit. So you can start with that, and then we'll talk about the benefits.
First of all, thank you for inviting me. Thank you very much. It's really, I first learned about the Georgists from our good friend and one of my fellow senior advisors at the Public Banking Institute, Scott Baker, whom I know you know from New York. Scott, I understand, is on this call. Scott is one of really our most respected experts on how banks work and what's going on in the trending of bank operations and the impacts on public money. A public bank is in some ways could be perceived as a misnomer, because it's not a publicly traded bank. It's a publicly owned bank. And yes, it is, at least in the formulation that we've devised it or that we subscribe to, which is evidenced or modeled by the Bank of North Dakota, the only public bank in the country, is that the state owns it, and the state of North Dakota owns the bank, and they are doing business as a bank. So it's not run by the Treasury Department. It's an independent agency, but it has very close governmental ties, and yet it has also its own integrity, run by bankers, not influenced by political and special interests very much, certainly not in North Dakota. And that, of course, I would just say, bringing it right to the front page, that is one of the greatest fears that we've come across in the country about why public banks might be compromised and turned into the kinds of banks that were publicly owned in the 19th century and before, that failed because they were compromised by special interests and politicians. But history has led us through a lot of different phases, so let me just describe in a very general sort of a way. I wanted to try to share something on the screen here, which is basically a look at how the schema, if you will, of what a public bank is versus a private bank. So Dan, I trust you can see this all now.
Yes.
I don't always believe my technology.
No, it's perfect.
Okay, great. So I call this the bicycle graphic. And of course, if we remember, we know, of course, that currency is about circulation. And I like this one because you can see that there's a failed circular system on the left-hand side, the private banking system, whereas the one on the right it continues to roll. Now, what is the distinction? In the private banking system, in a public setting, this bank has got a mission. This is an important distinction. The public bank has a mission to serve the public interest as it's devised by the people who own it, by the citizens and so forth. Now, obviously, private banks have a mission to maximize shareholder profits. And so it is a profiteering exercise in the use of public funds. So starting at the top of this thing, you see citizens. Let's say they pay taxes, and in the left-hand side, that goes to the state government. What does the state government do with those taxes? At the moment, with the exception of one state, all of that money is put into Wall Street banks, okay? The global financial cartel controls receives these deposits and then does what it does with it, which is speculate, gamble, whatever, invests, in a euphemistic term, invests into a variety of things, many of which the public around the United States are not too pleased with, which has been driving much of the public banking movement. So, for example, in California, the uprisings, if you will, in San Francisco and in Oakland and in Los Angeles and elsewhere has been around the preponderance of investment in, say, fossil fuels or private prisons or payday lenders or in other sort of other sort of categories of investment, corporate bonds and commodities and so forth. So they take their chances and they make their profits. Now, so Wall Street, of course, makes their profits. That's their business. Fine, it's fine. The returns that they give to us in terms of what they pay us for our deposits is a pittance compared to what they get. And of course, when we need money, when we want to build that bridge or that school, we have to go back to Wall Street to borrow our money back through the bond market, which is expensive. And multiples of fees, all kinds of limitations. And of course, with those various, very slick sort of Wall Street derivative CDOs, a variety of all sorts of investments which have been captured, which are hedge funds and pension funds and so forth, all bite into. That's how we have to borrow our money back. Now, on the right-hand side of this is what you've already probably checked out is a different sequence. When the public pays taxes, which are lower because the actual expense of governance is reduced because we retain our capital within our own bank, and because if we're financing ourselves, we can finance our infrastructure, let's say, for about 50% of what normal costs are. The state government then, puts it into its own bank, of course, and then it invests in the local economy. And this is a substantive, critical point about why this is so important and urgent, if you don't mind my borrowing my own phrase. The urgency of investing in ourselves and having access to our commonwealth is enabled by banks, which are, of course, monetizing our equity. And from investing in our local economy, we get new jobs, and of course, the profits are returned as well. So in the instance of the Bank of North Dakota, the profits that are returned have produced 15, I think now 16 year-over-year increased profits. And they've now achieved $1 billion in the last 15 years of revenue for the state through the banking operation. Now, that is a distinctive counter-cyclical example of the importance here. And I think you've seen enough of that. Let me make you look at me for a minute. And I have
Well, I wanted to ask you a couple things about it.
Oh, sure. You want me to go back to it?
It doesn't matter too much.
Okay.
I think I remember. Basically, the first thing was that the taxes are not lower at the immediately. The taxes are lower, in the subsequent years because the debt that has to be repaid is lower. So
yes, correct.
So even though you started with lower taxes, this is something I always have problem with land value tax, that there's a lower tax on homeowners if their building to land ratio is better, but the lower taxes overall doesn't come until the economic development comes that land tax triggers. And
Right.
I think the same thing is true here, that the lower overall taxes come because you've borrowed money, that the nominal interest is maybe a little lower, but part of that interest is returned in the bank's profits go back to the state, and those profits displace taxes.
Yeah.
So
Well, yes.
so you're saying lower taxes, but not necessarily the first year that the bank comes
No.
to
Right. No, I
operation.
mean, it typically takes banks a couple of years to get profitable. I mean, there are depending upon the scenario and the setting, but truly a counter-cyclical mechanism is instituted or installed into the government, the local government, local being state, county, city. But so, and that counter-cyclicality is a godsend at times throughout every year, because every year your equity is building. Now, in the case of North Dakota, they return their profits. They can either pay dividends, and sometimes they make their dividends are available for the state to recover from some unfortunate development, fiscal development. But by and large, the bank is investing in the economy that is on a lot of different levels, utilizing local commercial banks, local community banks, not big banks, but community banks, to create more lending and credit into the local economy. This is why North Dakota has had the lowest unemployment, the lowest foreclosure rate, the lowest credit card default rate, the lowest student loans. They have, and as you'll see on one of my slides, the Bank of North Dakota has been called by the Wall Street Journal the most profitable bank in the country, and is an icon, or at least I should say something that it should be the envy of Wall Street. So it uses banking as a civic utility, and I think here's another important distinction. That the banks that we know and that we relate to are all typically private, including the Federal Reserve, because the Federal Reserve is owned by the private banks. 6 global banks are the ones who hold the majority of the interests. And I think we can make a very clear case out of the recent news for the last 10 years that they manage their affairs in the interest of their client banks. But so we have banking for profiteering, or for profits, private interest, fine, that's no problem, or banking in the public interest. And so public banks are banks that are designed for serving the public interest. So all of the revenues that are gathered in from taxation, fees, and other sorts of resources become the base from which the community leverages its equity, which is what banks do exclusively, in order to be able to maximize investment and lower the cost of borrowing. Now, it's just, and again, I suppose we could go to the slideshow, and maybe, how about if we do this, and we'll kind of put all of this a little bit more context for us. Here, first of all, is a look at where, and just ignore the stuff on the left. That'll be a spoiler alert if you look at all the slides on the left. But technically, we're going to be looking at the big pictures. So this is where public banking has taken hold around the country primarily over the last 10 years. You'll see the one place where there's a public bank, the green state of North Dakota, which has a wonderful story to share with it. But you'll see that there are quite a number of of participating states that are either doing feasibility studies or have pending legislation or have organized and strongly well-organized initiatives to create public banks around the country. So
Before
it's
you go
growing.
further,
Yes.
I couldn't help but notice this even before the interview, is that this has worked very well in North Dakota, and yet all the states that are looking at it seem to be the states that are the least like North Dakota. And in other words, I would have anticipated that the people in South Dakota would be the very first people to say, yes, this works, let's copy it. And I'm looking at Montana and Idaho, Nebraska and Kansas and all these places, and wondering why there isn't a push in these states rather than in the states that are like, in a way, we're the big bank states. I would have thought that Pennsylvania, New York, Connecticut, and Delaware, and probably California would be the states that are the most thoroughly banker dominated. That not the community banks, but the big Wall Street banks.
The primary answer to your question, Dan, is that,
yes. Yeah,
but the answer to what I heard you say before we were cut off, Dan, was that there aren't any states in North Dakota. But to clarify your concern, because we get this, and I think that's a question that characterizes nature of the banking environment and system that we live in, and that is controlled and it overwhelms the communications and influences public policy, etc. So North Dakota obviously has got all its that are listed here, lowest default rate, most banks per capita, still the case. Around the public banks are very common, about 25% publicly owned. Little countries like China, India, Japan, etc. And of course, very importantly, Germany, which banks for about 300 years. So there, but not so much then. Previous examples in our own history include the Reconstruction Finance Corporation, very similar up to a public, which was highly successful and very profitable, but really invigorated the economy. And then, of course, postal banking, another variant of public bank, which is currently being revived. Mentioned before, the journal. Out that JP, the return on equity has been about 18%, really 17 to 26% return on equity in the 10 years, which is pretty extraordinary. That's not return on assets, return on. Okay, and here's why. Why is this bank so profitable? It has no private shareholders, so it doesn't have those dividends to pay. It has priced salaries, no bonuses, fees, commissions, high-paid CEOs, advertising, ATMs, all a very low, very efficiently run bank, and of course its savings are passed on and invested. And the benefit of why we want to have a bank on 10 by Hoyle, it's by policy, 10 to 1. So our resources, our tax money, that stuff can be leveraged 10 to 1 to lend into our own economy, which is major aspect and advantage of what this bank. How does it affect the economy generally in tough times? A look at what the public banks around the world were in terms of lending credit, which is the lifeblood of any economy, into their economies. Blue lines are public banks. So you see that even in 2008, when lending here in the US dropped 70% by and large, when you couldn't get credit, public banks around the country, public banks around the world have been just kept on. Also true in North Dakota. The bankers, the community bankers in North Dakota, the credit just kept on flowing through stances. And now, other aspects of having to deal with the private, it's very expensive. We pay multiple principal for funding the things that we need because we borrow markets. And of course, the private markets would make us dance to all kinds of tunes. And here we see now, we're at a time where the Fed changed its banking practices to reserve requirements. Are you with me?
Yeah, you had a little blank out for a second. They changed the reserve requirements is where we left off.
Yeah. So in the last month or two, the Fed, and now they've just opened up the spigots for bankers to, without any of the guidelines and the curbs that have been part of their requirements and regulations in previous years. So there's a new opportunity here for states and municipalities to take advantage and to be able to borrow as corporations, hedge funds, and banks do all the time from the Fed window. So to wrap up here, we can borrow interest-free from the Fed, and we can lend at 1 or 2%, for our own purposes, enjoy that spread. We can direct credit where we want it into our community instead of into Brunei or some other fancy market speculation. It stimulates the local economy and restores the tax base. That is to say, it helps to save money locally, and then of course they acquire some independence from Wall Street. All right, so that's enough of that. Maybe we'll get some more bandwidth here to work with.
Okay, you can start your video whenever you want to.
Okay.
There we go.
Okay, we'll give it a shot. So I mentioned a lot of key, I think, fairly impressive aspects and points about why the institution of a public bank represents a breakthrough, frankly, for especially at a time like this, where states are facing incredibly serious financial issues, not just now, but ongoing, because obviously the economic recovery is going to take a while. Much of it's not going to come back. Meanwhile, there will be a real need for credit, and not just credit for individuals, but credit for states. And as I mentioned before, the restrictions that states have is that they have to go to the market. Now, let me just say one final thing, and then I'll throw it back. You had mentioned that the Fed is, there's a debate about whether it's private or public. Well, you kind of know a duck by its quack. You have to judge a book by its cover, or you shouldn't judge a book by its cover. And you especially shouldn't judge the Federal Reserve by its cover, because it's not federal and it's not a reserve. They are basically doing the bidding of the major banks. If you read every day, you can read some of the, frankly, scandalous, fraudulent perpetrations that the Fed does with our money. Here's the thing. The banks, corporations, hedge funds, trading desks, and banks are all getting money at the federal window at 0% interest, 0.25% interest. When the
Which
Fed
is
has
below inflation, so it ends up being negative interest.
Great, exactly. And so when states and municipalities, because of the current orchestration of the limitation of our systemic design, do not have access to the Fed window, we have to go to the markets. And the Fed right now is telling states, hey, if you want to take advantage of this municipal liquidity facility, which has not been started yet in the last couple of months, I mean, it's there, it's on the books, but they haven't put out any money yet, they say, we'd really like you to go to the markets first. And if you can't get enough money from the markets, come to us and we'll lend you up to 20% of what your revenues were in 2017, and your cost will be whatever your market rating is plus a penalty. So in other words, states and municipalities do not have, we, the people of the United States, do not have parity with hedge funds, corporations, and banks who are currently the patrons and the owners of the Federal Reserve System. And I'll stop it there.
Yeah, that's, I think that's the most, I think the fact that you can borrow cheaper through the public bank, it's not necessarily the biggest, claim public banking advocates can make, but it's the most unassailable. It's just, there is no disputing that. And I've looked at things, you know, sometimes I think that Ellen and some other people kind of overclaim or oversell things. And then I look at detractors who kind of over detract. And I saw one was somebody said, well, in the 1990 recession, Ellen Brown said that the Bank of North Dakota had the lowest, you know, whatever failure rate, whether it was home mortgages or whatever it was. And they said, no, rural banks tend to do better generally, and that Kansas did better than Bank of North Dakota. And I thought, well, the whole purpose of your article was to trash the public bank idea. And you could only find one state that you could argue did better. And to me, it was still like, okay, they didn't do as well as Kansas, but they did better than Nebraska and Montana and South Dakota and Minnesota and Idaho and Montana and all these other rural states that have small community banks. So sometimes I look at this stuff and I see that polarization where if you extend your claim, you know, if you go out on too far on a branch, your enemies will saw it off. And so my own strategic approach, which is the same thing I do with land value tax, is I only make the claims that no responsible person can deny. Because whenever things started getting contentious, it always ends up in favor of the status quo. And so, you know, because it's kind of like, we don't want to deal with all this rancor, we'll just table this issue and go deal with something else. And I see two things. The most unassailable thing that you've said is that, you know, you can borrow, you know, your public bank can borrow at the same rate as all these Wall Street banks, and then lend it to, you know, and then pass on a smaller markup. There still has to be some markup because you have to pay for the administration of the bank. And my understanding, and you can maybe get the details of this, is that the public bank lends to community banks who then lend to the various, I don't know if the public bank lends directly to the governments of North Dakota, but my understanding is that for some things, the public bank lends to the community banks, and the community banks who have some expertise and some risk assessment focus then relend. And I don't know how much of that is,
yeah,
you could explain that.
Let me describe that. I'm glad you raised that because let me describe the architecture of how at least the Bank of North Dakota, and frankly, again, that would be the model that we recommend as well for several reasons. The Bank of North Dakota does not, actually by law, it's required to be to allow the public to make deposits, but it doesn't have branches, it doesn't have ATMs, it doesn't encourage people to make deposits there. Its sole purpose, its primary purpose, is to be to encourage and nurture the financial institutions of the state that are private financial institutions, the community banks and credit unions, to support them and to nurture them and to do things for them that they can't do on their own. So it builds a system of mutual support, a little like your own, having your own Federal Reserve in your own state, where they, and here's what they do. Because they don't lend to the public and they're not competing with community banks for depositors, they're not, in fact, it's just anathema to them that they would even do that. And so consequently, what they do is, for the community banks, is they use them as kind of front offices. So when they have lending programs for small businesses, for example, or some special line of lending, the Bank of North Dakota will say, will stand with the community banks that are making the loans, and they will partner with these banks to share the risk and also to expand the amount of credit that the community banks can give, which is very important because community banks are small and sometimes the credits are much larger than they can afford. They can't go that deep. But, here's kind of maybe a little story about something like that is, if a guy comes in and says, I want to expand my dealership and I need $10 million, Jim. I've been banking with you for 30 years. We did some agricultural stuff together. Can you give me the 10 million? And the banker will say, that's bigger than I can handle, but don't go across the street to Bank of America. Let me call Bismarck and I'll talk to the Bank of North Dakota. Bank of North Dakota is committed to small businesses and to the businesses of North Dakota. And they'll say, hey, if you guys send up his paper or send up their paper, we'll check it. You know these people. You think it's good stuff. We've got a relationship. Okay, we'll buy down the loan, or we'll take a risk, or we'll take a capital share in the bank. We'll do something to make this deal happen. Now, what's the impact of this? Very far-reaching. Because in North Dakota, 82% of the deposits are held by community banks. Everywhere else in the country, 18% is what the community, 17-18%, somewhere in that vicinity, of community banks hold the deposits. The rest are all Wall Street banks, but not in North Dakota. And so what you have is an economy that has got, again, this great circle of cycle of create a virtuous cycle of creating equity and borrowing and moving it back around and so forth. It's the thing that Ben Franklin bragged about, which got us all in trouble in England in 1764. When the king asked him, he says, hey, how are things going in America? He said, oh, by the way, Ben, how are things in America? And Ben said, look, you won't find a happier person on the face of the earth than the American colonist. And they said, well, why is that? Because in England, in London, people were living in squalor in the mid-1760s. And he says, well, because we extend credit to our citizens, and they build the houses and start their industries and so forth, and we don't have any taxes, and everything is going great. And of course, the king said,
they did have taxes, but
the
much lower
Quakers,
taxes, and only on real estate.
Okay, in 1710 or something like that, the Quakers, yeah. So anyway, so the king said, well, that's got to stop. You're not going to do that anymore. And of course, he being a patron of the Bank of England, which had just got started around that time. So that, interestingly, and I think we're kind of at this point again in our historical American narrative, that is what Franklin said was the real cause of the American Revolution. Yeah. Is that because when the Bank Act of 1764 went into play, things started to go downhill immediately. They had to pay all of their taxes in the kind of tribute
Bank of England notes.
Yep, and they couldn't do it. So people weren't. So they weren't surviving. And so when Franklin was asked years later, what was the real cause? Well, it was this. Now, we find ourselves in a situation, I would say, and this is my own commentary, okay? But I think we find ourselves in this kind of a predicament today. We have this enormous structural inequity and fiscal inequity as a part of our system. The people are being cut out of genuine and worthwhile participation in the economy. In part because they can't get credit, because the cost of it's just too expensive to live. So we have, and now we have our failed mega systems of society and the economy. We need, as you know, Stephanie Kelton, the MMT people would say, you know, we need to put our money, and as Keynes would say, and RFC demonstrated, we need credit, we need to put money in, but we're all obliged to borrow it from the privateers. And so we think that public banks, and one of the immediate things that we're doing around with states around the country is proposing to them that they take emergency action to set up these banks, because the big banks have been stopping this all along the way at every corner they can, with all kinds of spurious and questionable claims and attacks and so forth. But that's kind of where we are. It's kind of an exciting moment, frankly.
Yeah, the one of the concerns is inflation, and I think we want to be leery right now because we'll probably get inflation no matter what we do. Because, you know, they say inflation is too much money chasing too few goods. And right now, because of the quarantine, we have a different group. The Fed is predicting a 30% drop in the GDP for the coming quarter. The Forbes, I think, predicted a 40% drop. So when you have a 40% drop in production, even if the money supply remained unchanged, you're going to get inflation. And we are, you know, doing all the stimulus money. So that seems to be likely to add to that.
Well,
my concern, when Richard Vague was speaking about that, he said that he's never found inflation due to government created money. Yeah. And my reaction to that was, well, if government creates money, the response of the commercial banks is to say, well, we lend according to whether we think people can pay it back. And if the government's creating all this money, then the people will be able to pay us back. So my worry is that the government creation of money will trigger a big increase in the bank creation of money. And that it's actually the bank creation of money that causes the inflation, but the government creation of money encourages the banks to think, well, we can get paid back as the money is being created. So, you know, that's where my concern is, that we should do this, but we should also curtail, you know, with reserve requirements and stuff, we should discourage the commercial banks from creating money at the same time.
I would push back on a couple of things about that, Dan. I noticed too that Richard Vague made that comment. I thought it was very interesting. I think that Michael Hudson, Michael also talks about that inflation is not always and ever a monetary thing. It's there are other factors here, and Michael gives a different example. But what we have not been able to achieve a 2% interest growth, 2% growth in our economy for a long time. Japan has been working on it for about 20 years and they can't do it. But Ellen points out that because of the nature of interest, that we are all every year about $1 trillion short of currency circular. We need more money in the economy than currently exists to be able to just handle the debt that is owned publicly and privately. Because creating interest, you know, and the banks create the money, but they don't create the interest. So it you know, you have to, where does that come from? So that kind of inflationary aspect, which of course grows assets, you know, allows the financialization of the economy to speculate and to grow, to increase the prices. Well, that kind of asset inflation is different than fundamental economic costs like that. Yeah. So yeah. Those are a couple of.
And Richard Vague said that too. He said, don't worry about, he said, price inflation, like the price of tea or the price of you know, groceries, is
Yeah.
not where to look. It's asset inflation, and particularly the price of real estate is where the inflation usually manifests itself.
Yeah. Yeah.
And of course,
Absolutely.
we would tax land values, which has had a really good effect on reducing inflation. Now, does the Bank of North Dakota do mortgage lending?
It does through community banks. It doesn't do direct lending. The only direct lending that the Bank of North Dakota does is to students. And they have programs. They have the lowest student rate in the country. They actually serve South Dakota, Montana, and Minnesota, I believe, so those students there too. But it doesn't do mortgage lending. But what it does do for community banks, and again, another structurally important thing, is that it provides a secondary market for community mortgages, community bank mortgages. So the money gets to stay in the state. The community banks are relieved of the lending long, of the pressure of putting their capital out, lending their loans out for a long time. The Bank of North Dakota bundles that. They buy it off of the community banks, and the community banks then are free to put more credit out into the economy, which is why the community banks in North Dakota are the most profitable in the country by a factor of several fold, as well as the most numerous. Interestingly, and this is kind of an irony that we always deal with, is that bankers around all the other bankers, it seems, in all the other states, seem to be paranoid about public banks coming in and stealing their lunch. Maybe they're just generally afraid of competition. But the evidence is quite the contrary. Say, look, man, we're the best thing that could happen to you. To be able to have a state-based central source of sharing risk and expanding your credit worthiness, and protecting your franchise. We don't want you to go away. We understand that community banks are critical to local economies. They know the market. They know the people. And their business, and they've got their neck on the line as well. They're taking a risk. So that's real community commonwealth kind of generation. It's an important thing. So we try to make that case to bankers. They're a little slow to see it, but North Dakota is a shining example.
I would think since we're both in Pennsylvania, I would think that BNY Mellon and PNC Bank and we have some real heavy hitter Wall Street type banks, and that they would, I think their fears are not displaced, because if we were good for the community banks, that means that the community banks would be better able to compete with them.
Except for one thing, Dan, and that is that the big banks like that are not doing much in the way of small SME lending, small medium enterprises. They're not doing much of that. That's not how they make their money. They spend the same amount of time writing a check for $1 billion as they do writing one for 10,000 or 50,000. The community banks can do that. The big banks just don't. They're not even in the market. So we're really dealing with a different sector. And what we say at the outset in formulating the public bank is that we promise, or we're committed, we're not going to compete with you guys. We will not go into those markets where you are, because so that kind of framing to protect their.
And to illustrate that, when the Bank of New York merged with Mellon, they dropped their retail banking services and created a new corporation called Citizens Bank. Which, so if you had an account with Mellon Bank, when that merger took place, you found that you were offered an account with Citizens Bank, that everything, because Mellon can't be bothered. There's a French saying that Henry George quoted once, which is that lions do not eat mice. And that seems to apply here. So that's, and the other thing that my question about mortgage loans was that we seem to have given preferential treatment to mortgage loans, that the government has been under the illusion that subsidizing mortgage loans would make home ownership easier. And what it does is it gets capitalized into higher real estate prices. And you can see this in the real estate industry. They have formulas for when the interest rate drops, the price of the value of the house goes up, so that you end up paying the same amount of money, whether it's a cheaper house at a higher interest rate or a more expensive house at a lower interest rate. So I was hoping actually that BND would emphasize loans that increase productivity in the state. Even commercial real estate loans, the portion that falls on land especially, but in any case, the easier it is to get a loan, even if your collateral is just the buildings, the easier it is to get a loan, the more you can pay for the land, and the more the people who have the land would be inclined to charge you. So that's what I don't know. I mean, Fargo is a small enough town. I think it's the biggest. Is Bismarck?
I think Bismarck
is the biggest town in North Dakota, but it's
Dan, they're all small.
It's still small. Of all the big cities, of 100,000 people or more, Pittsburgh had the lowest foreclosure rate and the lowest negative equity rate from the 5-year period of 2008 to 2013. Pittsburgh had the lowest foreclosure and negative equity rate in the country. And I think has nothing to do with our banking policy, because Philadelphia was way up there, had a very high rate. But it had to do with Pittsburgh having a land value tax, so that the speculators didn't come in and drive up the price of real estate, that the homeowners were not competing with the land speculators in Pittsburgh. And we lost our land value tax in 2000, but the big growth of real estate prices, most of it had already occurred, and people still weren't looking at Pittsburgh as a place you speculate on. They're looking at it now, because now Pittsburgh has a reputation as being the only city where real estate does not crash. And they don't know why, and they don't know it's not true anymore, because now Pittsburgh has a conventional property tax, and real estate, we're having a housing bubble right now. It's the first one we've had since 1913, when we started shifting to land value tax. So, so the two kind of are harmonious in the sense that they both address the same problem and from the same principle, that the earth is a commons. Is the idea of land value tax is the earth is a commons, and you've appropriated it for yourself. And that's fine if you're doing something with it, but why should we tax you more for doing something with it than we tax the guy who's just sitting on it? Obviously, the whole reason we made land, nomads did not have private property in land. The reason we have private property in land is that you can make those permanent investments in the land. And why would we tax the permanent investments then? That's why we let you have the land in the first place. And the same thinking with regard to money is that all new money, again, that inflation is too much money chasing too few goods. Well, then obviously the people who have given the value to money are the people who are producing the goods and services that money can buy. They are the rightful owners of newly issued money. And the idea that you would the idea that you would tax those rightful owners while you lend them the money to pay the taxes, while banks create the money and lend it to them, and then banks collect interest on money that they didn't create its value, and they only created the money because they have a privilege from government saying they can. So, to me, the public bank is not the fundamental absolute end-all reform, but it's the closest we have to something that ameliorates that. Until we can say, banks, you have to borrow money from the Fed, or you have to borrow money from your depositors, who will have more money the less we tax them. Until we can do that, it seems like a public bank is at least the the seigniorage of the public bank, the ability of the public bank to create, monetized bank credit, which is almost as good as creating money, that seigniorage belongs to the people. And so in the state of North Dakota, at least one bank is returning that seigniorage to the people. That's, to me, that's a fundamental thing.
Yes, you raised the point that we make, which is that we believe banking should be a public utility, like water, electric, and all of those, all the other things that we rely on. That banking should not be a market profiteering exercise in the hands of people who are able to manipulate and inflate and otherwise, play with it. That the full faith and credit of our community has a monetizable value, and that a bank basically enables us to do that with prudence and with foresight and with a comprehensive look. Also, I think there's another aspect to money, and this is maybe, I don't want to get off some theoretical spur here, but when you look at money itself, it's really a relational device. And in the era of COVID, for me anyway, I think we're starting to see that our preoccupation with stuff, whether commodities and of course money itself, the accumulation and so forth, has been a distraction that is not infinitely supportable by the planet. Certainly, that our fundamental economy is nature. And that is the basis on which all of our growth is developed. And so we must work and create in relationship to nature as well as each other. So it's not okay for us to let people live under highways, 50% of the people living at, near poverty, not having, and putting them on the front lines of infection and letting them die. I mean, the question is, who are we? And what is money really meant? Or what do we have money for? Well, it is a relational device. And in my opinion, it's always been about relationship. I trust you. I respect you. I have some sort of, we're going to make some sort of an exchange together. Mm-hmm. That fundamentally is kind of where we're ground. So our systems and our institutions should certainly reflect that.
Yeah, and if you look at pre-monetary communities, all trade was within the community, and then there was barter between communities, or like with the common law societies of England when the Romans had left, but the feudalism had not yet arisen. What little money there was used for trade between clans and for foreign trade. And so the idea of that money was something you could trust when you didn't trust the person you're trading with implicitly, that and Henry George writes about this as well, that credit preceded money, but the credit he was talking about was not commercial or bank credit. It was, the Austrians talk about how difficult it is to trade without money, because if I want potatoes and you want a chicken, I have to have a chicken at the same time that you have the potatoes. And it wasn't like that at all. I would share my potatoes with you on the assumption that when the time came that I needed a chicken, you would share a chicken with me. That the whole thing was very informal and was based on a social trust, much like it is within a family. But it would, the tribe is an extended family, and so credit existed before there was money, and it existed before there was banks. So that's that's where progressive dinners started, where you would get a potato one time and a couple weeks later you get the chicken, and I attempted a joke, and progressive. Anyhow, the word feudalism, FEU, is the Old English spelling of fee. And feudalism began when money began to get into the system, because the lord was just a great person, and you rent to the lord for things. The lord would settle land disputes. He would be a landlord if he was good at settling land disputes. But what happened with the introduction of money is that the lord started accumulating money, and that gave him power over and above the power you get from being recognized by the community. So the rise of feudalism is very much tied to the introduction of money into societies. We have Q&A. We have 6 questions lined up, and I want to start just going to questions. And anybody if you move your mouse down to the bottom of the Zoom, you'll see a bunch of things, and one of them's Q&A. So if you want to ask additional questions, go for it. And so the original questions were the ones asked first. On the public bank versus private bank graphic, the private bank is shown investing in derivatives and other speculative investments. Isn't there some confusion between providing debt capital loans versus equity capital, or is this not an important distinction?
The investments that are represented in that graphic are of all types. Now, I think there's a distinction that we might want to make that would be maybe more clear, would be that investment in speculative markets, the financial markets, that's not, I don't know if that just asset investment, I guess, or financial investment, different than in productive investment. So we look at productive, have bank lending going into productive economy, not the financial economy. I doubt that I'm answering the question very adequately.
There's also consumer loans, but there's consumer loans, productive loans, and bank investments. And wasn't there more of a separation before Glass-Steagall, that the lending banks were discouraged, at least from engaging in their own speculative notions, and that has been eroded, at least.
Well, no, ended. The end of Glass-Steagall set us up for what we're looking at now. For the way that the banking industry, which of course is our money underwriting these banks, they're speculating in their own stuff. They're into their own commodities. They're into so they have commingled the public trust and responsibility, whereas it used to be separated, and really kept the banking group in line. Investors were one group of money speculators, but bankers were people who had the boring job of just taking deposits and making limited sort of credit available.
Okay. Ed Dodson said, how feasible do you think it would be for individual cities to establish public banks? And has there been any analysis of what the smallest size population, I assume, to be viable for a public bank might be?
Yeah, a good question. Well, we are working with both states and cities. The city of Philadelphia has got a feasibility study plan or a study, as has Seattle, Los Angeles, San Francisco, Oakland, just some of the cities that, and as well, Washington, D.C. So the size does matter. Really, you can't have too small of a bank. In fact, our colleague on this call, Scott Baker, has done a tremendous amount of quite numerous analyses of what a viable size is for a public bank, and has characterized the pro forma kind of expectations. So by and large municipalities or large counties would probably be able to do it, to have one. But you really have there are many other factors for that. Having a bank is not like running a Dairy Queen. You have to have a certain level of expertise, and that doesn't look like ice cream, but enough financial know-how as well as wherewithal to have a sizable enough deposit base for the bank and so forth. So those questions are very much dependent on the locale and the size.
Yeah, Pittsburgh and Philadelphia are surely large enough.
Sure.
They would basically need a state enabling law to do that. And also in Pennsylvania, I think many states have this, but in Pennsylvania, we have a concept called councils of governments. And a council of governments differs from an authority in that everybody on the council of government is an elected official. And so, 8 or 10 rural counties in Pennsylvania could get together and create a council of governments that in turn could create a public bank. And so it seems like, it doesn't have to be limited to big cities. It could be a combination. It could be smaller than a state, but it could be a consortium of smaller governments working together on it.
Yeah, like in a joint powers authority formulation.
Thank you. Nate said something about the technical issues we're having. Said it might have been related to somebody in the house downloading movies or doing something else that used internet capacity. I have no idea if anybody else is on the internet at your house, but that's just something to think about next time.
Okay.
Somebody asked, I'm sorry for the bad audio. Please send the presentation to the attendees. We will upload this to YouTube tomorrow or tonight, but definitely by tomorrow. It's the YouTube channel is Council of Georgist Organizations. So that takes care of those. Ed Dodson, adding to my comment about low-cost mortgage lending being capitalized into higher property prices. Ed Dodson, by the way, is a retired Fannie Mae executive. An even more important factor was rising land prices driving up the median price of a residential property. So in order to maintain transaction volume, the GSEs, what's GSE stand for?
Government-sponsored enterprises.
Okay. The GSE was forced to raise maximum loan amounts almost year after year until the markets became so stressed that the crash occurred.
Mm-hmm.
So I don't know.
But he's got some stories to tell. Yeah.
I thought, Robert Jean, I thought taxes already went to county and state treasuries from which they paid their bills and made public investments. Well, you pay the county treasurer, but they deposit it in a bank and then spend it from a bank. They don't have a pile of money in the treasurer's office. They have, it's deposited with the bank, and usually with a local bank.
Well, it depends on the size of the government agency. A lot of many of the bigger cities, small banks just can't handle the volume of a city. Like, so you have, they often typically wind up with the larger banks. Now, I don't think that's true on a smaller basis. Community banks, I think, enjoy municipal.
Probably a larger bank with a local office or something rather than a truly local bank.
Right. Yeah, that was one of the problems that the people in Los Angeles had when and San Francisco and Seattle, they wanted to get rid of Wells Fargo. They had a variety of sins that they didn't like that Wells committed, and they said and so the city council said, great, we'll change banks. We'll get rid of these guys. But they couldn't. They didn't have a place to go. There were no big banks capable of handling the complexity and the scale of the deposits. And of course, those deposits, the public deposits, have to be collateralized at a at a private bank too. So that's why big banks are often the only ones who can deal with that. Now, one advantage of the public bank framework is that the idea of collateralizing your own money seems to be a little foolish and unnecessary. So that is one of the advantages, if you will, that the public bank could realize.
Yeah, and it's an incidental kind of thing, but it's interesting. The city of Pittsburgh's greatest political scandal in our history was in 1910, when it was discovered that 6 large banks had engaged in a good bit of bribery, that all of the business of Pittsburgh and Allegheny County was going to these 6 commercial banks at rates that were not nearly as good as other banks. And none of these banks exist anymore under the names they had at the time. But a bunch of people went to jail. A bunch of we had a bicameral council, and one of the councils, the Common Council, was very large, but a bunch of council members went to jail. Some bankers went to jail, and the state abolished the city of Pittsburgh's government, just abolished it, and created a whole new government, and appointed people. Even though the state was also corrupt, they didn't want to look bad. Everybody was paying attention, so they appointed a bunch of upstanding citizens in 1910, and these upstanding citizens ended up being the people who they got reelected. But in 1911 they passed a law that started to go into effect in 1913, and that's how we got land value tax in Pittsburgh. But it began with a corruption scandal involving big commercial banks.
Those were the good old days, Dan, when you could actually send a bank to prison.
Yep.
We haven't seen that of late, and I don't know that we'll see it again. I know Scott on the call, and I read a thing called Wall Street on Parade, and I'd like to recommend that to all of you for an entertaining but provocative reportage. These people are Wall Street veterans. And they basically look at how the operations of the Federal Reserve are really go below the radar of the regulators. In fact, the regulators are okay. So that's another story. But there is quite an outrageous bit of unfortunate and really illegal behavior that is going on at the top levels of our federal financial institutions. And I think that's something for us to really make a note of. I know we're running out of time, but I think if at one point I would want to leave, in addition to whatever I've been able to share effectively about public banking, is that there is a need for us to really look at taking action to create some parity between the people in the form of states and cities and the private capital interests that basically run Wall Street and, of course, as Dick Durbin would say, own the Congress. We have to do that. We have to do something about that soon. And I think the emergence of MMT, which Mr. Vague beautifully, honorably referred to is an appropriate emergence about how we understand money and what's the capability is of it to serve our interest, the public interest, and to also hopefully keep us alive while the markets go through their various vagaries and turmoils, and hopefully leave us with something to work with before too long.
Okay. I think this is Mark Sullivan. It says Great Neck School of Dance, but I think it's Mark Sullivan. Henry George acknowledged Pierre Joseph Proudhon as inspiration for some of his ideas. Proudhon had proposed bank of the people and mutual banking in the 19th century. Is there a direct historical or theoretical connection from mutual banking and social credit movements to the current day public banking?
Oh yeah, yeah. I'm not an expert in those fields, but there's a very direct connection to social credit movement and to mutual banking. Yeah, that's all in that same spirit. You know, I think that it is about communities finding ways to equitably and efficiently work with credit, because it is the lifeblood of our relationships, our economic relationships. Yeah. Yeah.
Okay. Brendan Hennigan asks, what is the difference between a public bank and a cooperative society? I guess that's a cooperative mutual credit society. You were a
Mhm.
member and could invest your salary in the co-op and had normal bank, it says Cersus. I don't know if that's
Services.
maybe service is what it was supposed to be.
Services, yeah, yeah. Well, you know, I think we see the vestige of that probably most commonly shown in credit unions.
Yeah.
But I think, you know, the cooperatives, a very, very good example. The essential difference between that is that a public bank serves all, not just a closed a tribe or a group, a sector of the populace, but all of the resources and finances that come into a local administration, a local government. So it transcends the credit union restrictions of, you know, you have to be in a certain club or a certain area. This is all the people's money at a government level. And of course, a really important part of how this is executed will depend on the transparency of the bank and its accountability, and also, you know, having it be, as they say, a couple of arm's lengths separated from the political and special interests that are really always at the door of profiteering with the public's money. So that's, I think, probably one of the greatest risks that we've faced would be getting, you know, not having the kind of uh, 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 bulletproof governance protection that will keep the integrity of the institution intact.
Okay. And the last two questions we have are from Alan Ridley. I'll ask the second one first because it's closer to what you were just talking about. Why do localities need to write their own business plans for public banks? Can't we just use the blueprint from North Dakota?
Well, every bank charter requires that you have a business plan and a rather rigorous sort of a process for approval. So, and every community is different. Every economy is different. So that who are going to be your primary clients? What is your source of deposits? What is the cycle of your deposits in case of a government? So every bank needs its own business plan. Even if you buy an existing bank and take over with a new management, which is one of the strategies that we consider for creating public banks, you have to do a new business plan for the Department of Banking and Insurance or some other equivalent agency. Yeah.
I'm assuming you could start with the Bank of North Dakota's plan and tweak it to see, rather than write a plan from scratch. I would think you would start with by looking at other, looking at North Dakota's plans and maybe looking at plans of other countries and saying, let's incorporate these, and let's also be careful to look for whatever went right and whatever went wrong, and make sure we keep everything that went right and maybe fix anything that went wrong, but you would use one of those banks. And the other one is the other one, which is a good question to end with, is which localities are most promising, in a campaign to have public banks? Which places are
on the verge? Yeah, well, I'd have to say that I think New Jersey has a very good is far along in its process of evaluation, but also has some courageous leadership. at a time like this, that we're hoping that they will take a new look at it. We know that California is also positioned. They have last September approved a bill to create up to 10 public banks over 7 years in sort of a trial phase, but they've codified it. So creating a public bank in California is definitely on LA, San Francisco, Oakland, San Diego, I think, I know is also interested, Santa Clara, Santa Rosa, and all the other saints are in California. Also, New Mexico, Washington State has got a plan not in place, but that they've been working on for some time. Colorado, I've worked in about 30 different states with Hawaii, Alaska, I mean, goodness, Michigan. And interestingly, it's a bipartisan sort of a thing, which is a great relief and a great asset. The Tea Party people see the wisdom of the conservative nature of being free from Wall Street, being independent on their own. So that's good. And of course, you have the progressives who are also second nature to this. So I think that we have some very good candidates, and I'm hoping that maybe this coming year we might see the next public bank, the first public bank in 100 years, hopefully will be coming forward in the next 10 months, 12 months. We'll see.
Yeah, let me see. That's the one we got. I think that's good. Yeah, I don't know if we were talking about this at the beginning or prior to. No, I think we talked about it a little bit at the beginning. Is which states are most dominated by the Wall Street bankers? And obviously New York State is one, because Wall Street itself is in New York. But
well, then they all are.
My guess, well, but a lot of the rural states, I mean, the banks are influential everywhere. But I think, when you have Pittsburgh and Philadelphia are major bank headquarters. And so I was thinking New York, Connecticut, Pennsylvania, and Delaware, certainly, because Delaware is...
North Carolina is a big center as well. North Carolina is BOA and Wells and Delaware. Yeah. My point, not to be glib about this, but seriously, when you do an analysis or an evaluation of where the power lies in our government and in our country, it's with money. Now, who controls the money? And that the network is ubiquitous around the country. North Dakota is different, but at the moment they're the outlier. In every state, there's a strong bankers association. The bankers association is often most heavily influenced by the big banks. The community banks are kind of running scared. They're losing their foothold. Their franchise is diminishing. The big banks are, and frankly, on the federal level, the feds really want to do away. I say they really would rather get rid of all these little pesky banks, more to look after, more regulatory obligations, etc. So when you solidify and homogenize the industry, they can have more control and influence, and there you have, once again, the preponderance of power going to the few. And what we're trying to do is democratize money and the people's control of it by creating grassroots public interest banking institutions.
Has there been an effort to pitch this directly to the community banks as something that would help fight the domination of the big banks?
Well, I think that they may not see themselves as being victimized by the big banks, even though because they support the Bankers Association, they've got power, they've got influence, and they're friends. And not only that, community banks would like to, they're privately held institutions, they'd like to sell out and make some money for the shareholders. So if a big bank is interested in their community bank, hey, this is how we've lost 7,000 or 8,000 community banks in the last 10 years. We used to have 17,000, 15,000, I think, in the turn of the century. Now we've got 5. So this is a problem. This is not a structural problem, a democratic problem, a cultural problem. When we lose control of the money, when we don't have, and this is why I got involved to begin with, because it was pretty obviously to me that if we can get our hands on the lever of money, then we will have some ability to affect public policy. And public policy is where things get done for the community and for the people. But you cannot affect those changes if you don't have some equity or some parity in the game. You look at the Princeton study a couple of years ago that said, look, in the last 40 years, there's no statistical evidence, no significant statistical evidence of the ability of the public to get the policies that they have requested. So this is a danger to our democracy, and that's why I think we should be paying attention to these dynamics and to the particulars moving forward.
Okay, well, that I think that wraps it up, unless there's a new chat question. Nope, that's the one we had. So, so I would say to people, what the Public Banking Institute, is there publicbanking.org, or what's the?
It's publicbankinginstitute.org.
Yeah, publicbankinginstitute.org. And again, Walter is on, if you search YouTube for Walt McRee, you'll get his other presentations. And this presentation will be up on Council of Georgist Organizations channel. And
I might also just say, Ellen Brown and I do a radio show, which will be airing again tomorrow, every 2 weeks on the Progressive Radio Network. It's called It's Our Money. And tomorrow, Ellen will be talking about how this recent COVID funding is another bailout for the big banks. Very cleverly done, but it's covered by a virus, and no one's knowing. People aren't noticing how that's happening. But we'll also have as our guest Amaya Pewar, who was a city councilman in Chicago, who's been promoting public banks for years and looks at how it impacts the neighborhoods there. So that's also a podcast, by the way. It's ourmoney.podbean.com.
okay. Well,
thank you very much.
Thank you.